You're watching Unlimited Options Investing. It's me, Adam, and this video we are going to be talking about what the stock market has been doing ever so sneakily over the past 3, 4, 5 weeks, making up those higher lows and those higher highs, especially during the whirlwind of noise that we have been going through. In Arabic, we say a dosha. When you're able to block out that dosha or that noise and consumer sentiment being as low as it's been, people are bearish more than ever. The absolute best thing and the most objective thing is looking at the price action. It's really as simple as that, which is why I like technical analysis so much. That being said, we know during bear markets, especially the past one in 2008, 2009, during that recession, bear market rallies or bull traps were absolutely vicious to investors because, again, everyone's bearish for the most part, and we are a part of a bigger downtrend. At the same time, when you get those rip rallies of 5, 10, 15, 20%, and they do happen, the market can really trap and infuriate and frustrate investors because you see those rip rallies of 5, 10, 15% as we've seen before, just for it to ultimately make a lower low down the road. And again, all of a sudden you're at 52-week lows, you bought at the high, and then all of a sudden things are down, and then it's a whirlwind. It's not fun. So let's get right into it. Don't forget to subscribe and smash that like button. Alright, so the S&P 500, the SPY, was at 0.64% on the day. If we take a look at the past 5 days, we are up 5.63%, and over the past month, 5.26%. This is nothing to scoff at because if we look year to date, we are down 17.36%, especially after this past rally. So it was much worse 5 days ago or a month ago. Likewise, as usual, the NASDAQ, which is more tech heavy, was at 1.57%. Over the past 5 days, up 7.05%, and over the past month, 7.79%. So as we can see, the NASDAQ, the tech-heavy NASDAQ, has been outperforming the S&P 500. Year to date, though, it has been outperforming toward the downside, down almost 25% year to date. And that's after the 7% rally that we've been seeing over the past couple of weeks. So we hit a low back on June 17th. We reverted back to the mean, the 20 moving average. Again, we're on the daily time frame. We did trade sideways, however, we didn't go as low as the previous low back on June 17th, creating a higher low. And even now, we see that we've broken above that 20 moving average for the time being, now testing the 50 moving average, which comes at a very interesting time. As we know, it is earnings season, and what we want to see is a break of that 50 EMA, which is something we haven't seen with conviction in a very long time. The last time we were above that 50 EMA, and it looked like we were going to break out, and it was a huge fake out on the market, trapped a lot of investors, including myself, at the end of March. After that first rate hike, we had a really violent rally toward the upside, and again, we were above that 50 EMA, above the 200 moving average, this purple line over here, and since then it completely dumped. So just because we do break that 50 EMA on the daily doesn't necessarily mean that we are in the clear, but again, each encouraging sign just builds on the other. Zooming out and taking a look at the weekly, we're still below the 20 and the 50. However, we didn't necessarily touch that 200 simple moving day average. And again, if we are going to enter a prolonged time of increasing interest rates, consumer sentiment going down, we are entering a real and violent recession, even more so than a potential mild one. We would break that 200 simple moving day average. However, it has held up so far. And if we zoom out, it has held the test of time, each time bouncing off the 200 simple moving day average, except for during the COVID crash when the Fed did step up. So we'll just have to see what happens, but the 200 SMA is a very strong area of support when it comes to the S&P 500. And when you take a look at the monthly, and similarly, the 50 moving average also acts as a very strong support, as we've seen ever since that recession in 2008. Again, if we are in a really bad recession, we're going to break right through it, which coincides very nicely with the weekly 200 SMA. But again, on the monthly, the 50 EMA does act as a very strong area, which we have been bouncing off for the time being. So it isn't necessarily surprising that we are seeing a rally, especially bouncing off this area on the SPY. We'll start off with the QQQ on the daily, and then we'll make our way toward the monthly. Again, we know it has been outperforming the SPY, as this one has been above the 50 moving average as of today, whereas the SPY is still testing that area. So it does make sense that this one is above its moving average for the time being. Again, these are just baby steps for the time being, which are required in order to see a bigger recovery down the line. But just because you have baby steps doesn't mean that recovery is going to for sure come toward us. If we take a look at the weekly time frame for the QQQ, Again, we were near that 200 simple moving day average, but we didn't quite break it, but we still are below the 20 and the 50. And if we take a look at the monthly time frame, similar to the S&P 500, we are bouncing off that 50 EMA very, very nicely. Again, we are between the 20 and the 50 again for the time being. So the one chart I want to take a look at here is the QQQ relative to the S&P 500. Again, we know, as I've said like 10 times already, the NASDAQ has been outperforming, and this is the chart that tells you that it actually has been. And similar to when you're looking at the price action of a stock or an ETF, when you take a look at the correlation between relatively the QQQ to the SPY, you can see there's also been higher lows and higher highs. And just to illustrate that, you see again the higher lows in this area over here, and to illustrate, you see the higher highs in this area over here. Again, this is really encouraging. We are potentially getting a crossing of the moving averages. However, we are entering an area of, let's say, 0.77 or between 0.77 and 0.8 where that correlation does start to weaken. And for lack of a better term, selling pressure and needing the S&P 500 to catch up to the NASDAQ, and especially as we are getting toward the top of that range. But again, it could just break right through it. But that's something we do want to take into consideration. And let's say we are to zoom out, let's say on the weekly, we see that we're also on the 200 simple moving day average. And this is why I love technical analysis. It's very similar to math, is that it's all interconnected, the weekly and the correlations and the monthly and all these different time frames of different securities and ETFs. They all kind of come together. It's not like one is one way and one is completely opposite. There are the different correlations that you can make, and just it comes together. It's really interesting, at least to me. So zooming in, again, we are bouncing off that 200 simple moving day average. And this is something that I was looking at for the past few weeks and couple of months, is like, okay, if we don't hold these areas, like we're going to break through areas that we haven't broken since past recessions. And at that point, it's just free for all and everyone's kind of screwed at that point. Things don't go down in a straight line and things don't go up in a straight line. There are reversions to means. And right now we are seeing that relative strength. Again, when you zoom out, again, that 200 simple moving day average acts as a very strong area that we've been seeing year after year, again, since that recession back in 2007 and 2008. And likewise, if we take a look at the monthly, similar to how we saw with the SPY or the QQQ alone, that 50 EMA acts as a very strong area, which again coincides very well with the 200 simple moving day on the weekly, and just bounces off as it has been every month ever since back in 2008, 2009. So again, not saying that the damage is completely over, but if we are to have a short-term bottom, we are seeing the baby steps of that happening. And it's not just from looking at one thing or another. You just try to take a look at everything together and see if it does actually make sense to your thesis or if it doesn't. Another correlation that we can take a look at is the XLK to RSP. So XLK is an ETF that is primarily made up of the big tech names, specifically Apple and Microsoft. And RSP would be the S&P 500, but equally weighted. So seeing how some sectors in the S&P 500 are in correlation to the average of the other sectors. And again, what are we seeing? Higher lows, and we're seeing higher highs. Again, these are just the baby steps. We have to see a confirmation. Still in the bear market. Depends on what the Fed does at the end of the month. Are they going to change their stance? What's going to happen? Until they do, I'm still very skeptical at these like really strong bear market rallies that can occur. But at the same time, we're taking the price action for what it is, and these numbers don't lie. Similar thing, if you take a look at the weekly, we were approaching that 200 simple moving day average, and taking a look at that monthly, floating between the 20 and the 50. And lastly, I want to take a look at XLY compared to XLP, the correlation between the two. So XLY being consumer discretionary, so you have names like Amazon, you have Tesla, and then XLP, you have the staples, things that you need to buy no matter what's happening in the economy. Whether it's diapers, deodorants, shampoos, food, just a bunch of different staples that we can't live without regardless of the economic conditions. And what we're seeing here, and what I like to use this as actually, is a risk on versus risk off kind of mentality. Again, despite what's happening with consumer sentiment, these are the ratios and the numbers that I want to take a look at to block out all that kind of noise. What we're seeing is a miniature breakout, again, until we get above that 2.19, 2.2 area with conviction. Again, you still want to be a little bit skeptical, but again, we're seeing the right signs, at least for something a little bit premature, in order to happen for it to continue later on. And a different factor we also want to see, again, this is all interconnected. Again, these correlations don't necessarily need to happen, but it would be encouraging, it would make more sense, if things like the Dixie or the DXY, the US dollar currency index, as well as the 2-year yield and the 10-year yield to both come down or trade sideways and not continually make new highs, because that would also show that money is potentially flowing into bonds and into the stock market versus hoarding it into cash and selling your bonds. And because again, yields and bonds, as the yields go up, bonds go down. So if we see bonds go up, that means the yields are going to come down as well. So potentially money could be rotating into those bonds and to those stocks. All right, so let me know in the comments below, do you think this is a bear market rally, or is this a sign for things to potentially come? Is the bottom in? Are we going to see one last bottom to trap investors, and then are we good to go? Let me know your thoughts and your comments below. As always, subscribe, like the video, and check out my description below to links to my social media, my Instagram, my Twitter, and my TikTok. I will see you guys in the next video.